I view geopolitical shocks as catalysts that create market inefficiencies. That is to say, people react and they don't look past the crisis.
All right, joining me will be Rob Arnott, founder and chairman of the board of Research Affiliates, who back in September, they launched their second ETF. This is under RAFI Indices, which is the index company of Research Affiliates. So the ETF is the RACWI US ETF, ticker RAUS, R-A-U-S. And in a nutshell, this essentially takes the companies in the S&P 500, but changes the way they're added or dropped from that index by looking at various fundamental factors. We'll get into all of the details of this. But Research Affiliates overall, of course, they are a global leader in indexing. They currently power the indices behind 20 ETFs here in the US, about $86 billion invested, including from major issuers such as Invesco, Charles Schwab, PIMCO. Overall, we are talking about some $180 billion in assets managed worldwide using investment strategies developed by Research Affiliates. And so Rob and I are going to discuss that indexing business. I also want to get Rob's thoughts on the current market environment. And again, we'll spotlight that recently launched ETF as well. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in the one and only Rob Arnott, founder and chairman of the board of Research Affiliates, who is joining me from Miami. Rob, it is so great having you back on the podcast. It's always a pleasure.
Well, thank you for inviting me. This is always wonderful fun.
All right, so there is a lot I want to get into, but I thought let's actually start with the current market environment, because I think that will help set a nice backdrop for us to discuss the RAFI ETFs and the indexing business. And I guess the way that I will tee this up for you is we still have a lot of the same concerns from the last time you and I spoke, which was early last year, right? We still have a top-heavy S&P 500. We still have historically elevated valuations. There are still concerns over the quote-unquote AI bubble. There are still worries about inflation. At the same time, we have mixed economic data. And then we can now add to all of that a major geopolitical conflict with Iran. And so to start, I'd love to have you just offer your overarching views on the U.S. equity market right now.
Well, first, I view geopolitical shocks like Iran as catalysts that create market inefficiencies. That is to say, people react and they don't look past the crisis. And the result is you get significant market moves that ultimately tend to mean revert. And war in a resource-rich region of the world is a big deal. The oil price shock was kind of fascinating. You know, when the invasion happened, oil markets initially went up moderately. And I looked at that with puzzlement because Straits of Hormuz are adjacent to Iran. Any military action there would risk closing the straits for potentially weeks. And so I saw it as likely to have a major impact. In fact, if the straits were closed for, let's say, 6 weeks, $200 oil would not be at all out of the question. And so I was kind of interested that the markets reacted so mildly. Now, roll the clock forward 3 years, 5 years. There will obviously be a different regime in Iran. I say obviously because the ones who were in charge are dead. I don't necessarily mean it won't be an Islamist state. But I do think that it's highly likely that the leaders of Iran 3 to 5 years hence will be leaders who don't play games with exporting terrorism because the downside for them is just too great. And as a result, I would expect a more benign player, not because I think that the people likely to take charge are benign, but because it's hard to be less benign than the folks who were in charge for the last 40 years. that's one thing that the market and observers, and especially the media, tend to not do is look past the current crisis. And from an investment perspective, that's always useful. So, from an investment perspective, we're not very far removed from where we were a year ago. We still have inflation risk, but probably more muted than is widely perceived. I remember when Trump came in, and especially after so-called Liberation Day, the narrative was we're going to get an explosion of inflation. And I did simple arithmetic and said, okay, 11 or 12% of our economy is imports. If we slap 15% tariffs on all of those imports, that's going to be about 1 2/3% revenues coming in to the Treasury, and escalation in end prices as a maximum and as a one-off. Now, if suppliers, foreign suppliers, embrace or are willing to accept sharing some of that burden in order to maintain market share in the US, then maybe the endpoint impact is half that, or about 0.8%. So, in effect, that's more or less where we wound up. And the implication of that is that the 2.7% inflation last year, 0.8 of it was tariffs, and that's a one off. That's not a recurring thing. Yes, the tariffs persist, but you don't get 0.8% and 1.6% and 2.4%. You just take a step up, and then that's it. And so I thought the technical term freak out relating to inflation risk was over the top. The same thing applies to the oil shock. I mean, the oil shock is a very real one. It could turn into a big one if Straits of Hormuz remain closed. But again, that's a one-off step up in pricing. And the result of that moderates when the Straits of Hormuz do eventually reopen. So I view a lot of the shocks that are happening today as catalysts for moving markets further away from where they ought to be, and simply create inefficiencies that are not that difficult to exploit.
What about on the valuation side specifically? There's been a lot of talk. If you look at valuations right now, they are historically elevated. Does that give you concern, given everything that you just talked about that's going on elsewhere?
It does. I view U.S. markets as a less friendly place to invest over the coming decade. The notion of American exceptionalism justifying higher multiples is, I think, entirely legitimate. And it's not that we're better and smarter and deserve higher multiples than the rest of the world. It's that we have a slightly less intrusive regulatory regime than the rest of the developed world and much of the emerging economies of the world. And that frees up private enterprise to create growth. And so I do see the narrative of American exceptionalism as having that element of legitimacy, which just justifies premium multiples. But does it justify a 2x ratio? The Shiller PE ratio for US versus rest of world a year ago was 2-to-1. Now it's about 1.8-to-1. It's still a huge gap. And so I see the best opportunities as being non-US equities, especially on the value side, and to a lesser extent, especially on the smaller cap value side. So to the extent your viewers have little invested overseas, they may want to think about spreading their risk and diversifying, picking up some non-US exposure, just using broadly diversified ETFs or mutual funds. Schwab and Invesco and PIMCO have fundamental index-based strategies that give you a value tilt relative to the broad markets and that create direct exposure, broad diversification, and risk mitigation if the so-called AI bubble winds up bursting. And so take some chips off the table.
Well, it's such a great point on international equities because, as I know you're well aware, we have seen fairly substantial outperformance over the past year and a half. I mean, if I look since the beginning of last year, broad developed international equities, those are up somewhere around 35%. Emerging markets are up over 40%. That compares to about 17% on the S&P 500. And I think, as you know, what's happened over the past 10 years or so, investors and advisors, you look at their portfolios, there is a significant home bias in the US. They've continued to overweight US equities. And I think part of that is, every year we've come into the year and the prognostication has been, well, this is going to be the year for international equities. And every year investors and advisors have been disappointed. But now it does look like maybe we could have sustained outperformance. And to your point, valuations look more attractive. So you can see, this shift starting to occur. But it sounds like you think this could be sustainable.
I think it's sustainable. And I mean, to be perfectly candid, I've been one of those saying for several years, international diversification is an important part of your toolkit, and international assets are cheap. Cheap doesn't mean immediate outperformance. Cheap does mean long-term higher rates of return. And we have a website called Asset Allocation Interactive. And if your viewers simply Google Asset Allocation Interactive, the first non-sponsored link will take you straight to that website. Well, we provide forward-looking return expectations for about 160 different asset classes. And what's interesting about that is, how do we know what the future looks like? Well, we don't, but we know that the return on any asset consists of its yield, its growth in income, and changes in valuation levels attached to each dollar of income. Simple as can be. And so yield, we know what that is. Historical growth in income, we know what that is. For fixed income, it's 0. For stocks, it tends to be CPI plus about 1.5 or 2. And then changes in valuation levels, that's the biggie on a short-term basis. In any given year, that's 90% of the volatility. Changes in dividend yield, changes in bond market yields. But on a rolling 10-year basis, it becomes less and less and less important. On a 20-year basis, hardly at all important. And so yield plus growth plus revaluation are the components of return. On a 10-year basis, you can reasonably bet on some mean reversion. If the US is at a Shiller PE ratio of 40 and international markets are at a Shiller PE ratio of 20, maybe they converge to 35 versus 25 over the next 10 years. That is enough to make a big difference in returns. And so on a 10-year basis, we're currently forecasting 8% for non-US stocks and less than 4% for US stocks, which, by the way, splits between 6% for value and 2% for growth. Growth stocks are very expensive. Now, the AI revolution is very real. Anyone who spends a decent amount of time, half an hour a day, playing around with AI realizes how incredibly it can leverage our time and increase our productivity. Anyone who's not spending a half hour a day playing around with AI is making a big mistake. 3 years ago, early days of ChatGPT, we have an all hands meeting every quarter. And first quarter of 2023, at the all hands meeting, I said, you're going to be hearing a lot about AI this year and in the years to come. And it's the real deal. It's very important. I can assure you that not a single person who works for research affiliates, none of you, risks losing your job to AI, despite all of the media narrative. You risk losing your job to somebody who knows how to use AI better than you do. So start studying. And that's the essence of it. It's an incredibly powerful tool. And people who aren't exploring how it can improve their productivity are making a big mistake. But while the AI narrative is real, the other parts of the narrative resemble the dot-com bubble. Remember how it was said that it's a new paradigm. The internet is going to change everything, how we communicate with clients, with friends, with family, how we get our news, how we do our research, how we get our entertainment. And it did. The narrative went on to say these are the dominant players in the internet, and they all have a moat. They have a nearly impregnable control over their segment of the market. And so it'll be very difficult for competitors to break in. It's becoming a mature market. And this is going to happen really fast. Okay, well, that narrative was mostly correct, but it was incorrect in suggesting that the moats would be impregnable. Um, on a 1 year horizon, nobody can break through the moats of NVIDIA or the rest of those players. But on a 5 year basis, there are disruptors. On a 10 year basis, who knows? Anything can happen. And so the notion of the moats protecting the dominant players is always overstated. And the notion that this will happen fast is almost always overstated. The simple reality is that people embrace change grudgingly and gradually. And so, did the internet change everything we do in a huge way? Oh my God, yes. But was 2005 all that different from 2000? Not really. It takes time. And the same thing will happen with AI. It'll take time. So, yes, I believe AI is very real. And yes, I believe AI stocks are in somewhat of a bubble. The notion that you can have Palantir peaked at 140 times sales. It had 3 million revenues and was priced at over 3 billion revenues and was priced at over 400 billion market value. Well, how on earth does it generate enough profits to justify a 400 billion market cap? It's implausible in the extreme. So I think markets move beyond sensible levels. And when that happens, does it mean as soon as the market gets expensive, you sell it? No, it means you start taking chips off the table gradually. And just like people talk about averaging into bargains, average out of frothy stocks. You don't have to leave all your chips there. You can start playing with house money by taking some of that off the table and putting into markets that are cheap.
On the topic of AI, and I love you're setting this up perfectly because we can start talking RAFI indices and ETFs with your last point there. But before we do that, on the topic of AI, I'd love to have you elaborate just on how you think about this as either a positive or negative disruptor. And you were touching on some of the key points here, but the way that I would lay this out is clearly there are a lot of concerns that AI could result in a big negative for the labor market, which ultimately would filter through to the economy. On the other hand, we know the efficiency gains and the productivity gains that we're seeing from AI. And you think about what they might do to profit margins of companies and how all of that moves forward in a positive way. How do you think about that sort of tug of war there? Because I do think that's one of the biggest points of discussion in the markets right now.
Well, every technological innovation in the history of mankind has been a disruptive influence, has destroyed millions of jobs, has created millions of new jobs. The old cliche of the buggy whip manufacturer. Okay, internal combustion took care of that. The mechanical loom put millions of child laborers out of work, kids working in mills on conventional looms and losing their fingers to those looms. And how many people regretted the loss of those jobs? The Luddites went around smashing the mechanical looms because their children were being put out of work and the families were having trouble feeding themselves. Roll the clock forward for any technological innovation in the history of mankind by one generation and ask how many of those jobs are missed. Computers put computers out of business. What am I talking about? Well, computer used to be a job description. Somebody unusually facile with math. There was a movie, Hidden Figures, about the computers who helped us get on the moon. Not mechanical computers, human computers. And a generation later, were the jobs of computers missed? Heavens no. And the same thing will apply to AI. Yes, it's going to put a lot of people out of business, but a generation hence, will those jobs be missed? I'll give you a specific example, kind of out of left field. One of our first uses for AI, early 2023. We publish a lot of papers. They show up on our website. Anyone who looks up researchaffiliates.com can see literally hundreds of research papers. And it used to be we would hire 3 graphic artists, give them the paper, and say, make us a graphic that represents what you think is the essence of this paper. And the graphic artist would submit their best ideas, and we would pay them, of course, and then we would pay an extra grand to whoever we chose their graphic. And with ChatGPT, and with Dolly, we experimented and said, "Here's a paper. Do a graphic that describes the paper." And 4 times in a row, we chose the AI generated graphic over the graphic artists, and bingo, there were 3 graphic artists for whom we were doing contract work, hiring them for contract work, didn't have contract work anymore. Wow, that's disruptive. And I feel badly for them having to find something else to do or finding other customers. But that's the nature of progress. Actually, I have a yoga instructor who is also a graphic artist. And I said, "Are you using AI?" And she said, "Oh my goodness, yes. What used to take me 2 hours takes 2 seconds." Now, she doesn't get paid as much for the 2 seconds as she got paid for the 2 hours. But okay, that's a change.
Okay, so but it sounds like largely positive then.
I think it'll be massively positive. I think it'll be massively negative for millions of workers who get displaced and have to find something else to do. Um, Autonomous vehicles are out there. You can get a Waymo in lots of cities. The regular taxi driver and limo drivers are at risk of losing their jobs. About 2, 3 years ago, I was in a car from an airport, and I said to the driver, "Are you worried about autonomous vehicles?" And he said, "What's that?" I said, "Cars that drive themselves, and so they don't need a driver, and they can pick you up at the airport, drop you off at a hotel." And he said, "When's that coming?" And I said, 5 to 15 years. And he said, "Oh, I'm going to be doing something else by then." Okay, great. So yes, it'll be disruptive. The existential threats that people talk about, I think, are an outlier risk. I don't think it's a zero risk. Existential threat is AI decides it doesn't need human beings anymore. I don't think that's zero odds. I think it's a 1% risk on a 50-year horizon. Uh, well, shit, that'd be bad. But nuclear holocaust is a much higher than a 1% risk on a 50-year horizon, and so that's self-inflicted.
Okay, so I think we've set a nice backdrop here with the markets. I could probably talk markets with you for hours, but I think we have a good foundation here. So let's now talk RAFI indices and ETFs. And I guess first, Rob, I think many people watching or listening, they're certainly familiar with your general approach. But for those unfamiliar, do you want to explain some basics here, perhaps offer a snapshot of your higher level investment philosophy? I always think it was a point you made earlier where essentially growth stocks in an index are reweighted down to their economic footprint, whereas value stocks are reweighted up to their economic footprint, just at a high level. But you explain it. You talk about your overall investment philosophy.
The genesis for RAFI, the fundamental index, was a dear friend of mine who ran an organization called the Common Fund, uh, said to me, "There has to be a better way." He sat on the board of New York State Pension. They had a huge chunk of their assets in S&P indexation. And at one stage, Cisco was 4% of the portfolio at a time when it had only, I don't know, 20,000 employees worldwide. And it was second biggest market value company on the planet. And subsequently fell well over 90%. Okay, he said there's got to be a better way. We shouldn't have a strategy that sucks us into a huge allocation to a little company. Marty Leibowitz, who at the time was at TIAA, the big university pension fund, he was also part of these conversations. And I'd long thought that it didn't make sense to have an index that weights stocks in proportion to the price. So if the fair value is here and the price is here, it gets a lower weight. If the price is here, it gets a higher weight. You're going to have most of your money in overvalued companies. Now, indexers will say, yes, that's correct, but tell me what the fair value is. Otherwise, you haven't said anything useful. And that counterargument carried the day for half a century and discouraged people from looking into alternative approaches to indexing. I'd long thought that simply looking at the sales or the book value of a company and weighting the company by its sales or its book value would make just as much sense as cap weighting. In fact, more sense because it has a rebalancing alpha. If the price soars and the sales don't, if the price soars, the market's telling you the sales are going to soar. And if the sales don't, what about reweighting back down to the sales weight? So you'd get a rebalancing alpha by contra-trading against any price moves that aren't validated by the underlying fundamentals. We called it fundamental index. You select companies based on how big they are, not how valuable their stock is. How big is their business? You can do it on sales, on profits, on book value, on dividends. We even have a multi-billion-dollar client in East Asia, Taiwan pension fund, that does it based on number of employees. And they all work. They all have that rebalancing alpha. They all have a value tilt. Companies trading at premium multiples are reweighted down. Companies trading at a deep discount are reweighted up. So you get this constant value tilt, but you're also contra-trading against price moves that aren't validated by the fundamentals. So that's the essence of fundamental index: fundamental selection and fundamental weighting. Now, the value tilt for the last 20 years has been horribly damaging because we've had a growth-dominated market ever since 2007, and most particularly ever since about 2016 or 2017. And so that's nearly a decade in which value has struggled horrifically. So with a value tilt, our performance is pulled down. With a rebalancing alpha, we recoup some of that. And the result is we beat the value indexes when value's losing, and we beat the value indexes when value's winning. So if you're always beating the value indexes, then if value is underperforming by 5% a year, it's too big a headwind. If value is neutral, great, you're going to add a couple percent a year. And so RAFI has a history now going back 20 years of winning roughly 3 out of every 4 years relative to value. Value has, over that same span, underperformed about 3 out of every 4 years. And so RAFI, I like to play the alternative reality thought experiment. What if value had done fine the last 20 years? There'd be $1 trillion in RAFI. It would be ascending and viewed alongside cap weight as a very legitimate alternative to cap weight. That didn't happen. And so what we find is that the performance against value indexes is relentless. And right now, value is extraordinarily cheap. So therein lies a huge opportunity. As you say, there's a lot of money tied to RAFI. There's about 160 billion in RAFI or RAFI related strategies. And there's probably a similar amount in imitating strategies. There's a number of competitors that offer products that do fundamental weighting, but not fundamental selection, or do a little bit of both, but they stay away from our intellectual property by not replicating, but by borrowing some of the principles. And their records are also very good. Their performance relative to value is superb. So that's RAFI. And it's been an exciting ride for the last 20 years, and wonderful to see it gain so much traction over a long period of time against horrific headwinds. And so our work since then has been largely borrowing from our own idea and looking at ways to do better on the growth side, better on the core side, and we've had a lot of fun.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Okay, so this is absolutely perfect, because as I was thinking about our conversation, there's something that I would love to hear your perspective on, which you started to get into there. And the way I would lay this out, Rob, is if I look at year-to-date ETF flows, the top of the leaderboard is littered with the usual suspects, right? It's the largest plain vanilla market cap weighted ETFs. And this is not new to what you were alluding to. This is pretty much what we see.
IWB, you name it.
Right, VU and Chill. But if I look at the performance of a number of your RAFI indices, they've actually fairly handily beaten a number of these plain vanilla indices over the past several years. And so, for example, if I look at the Invesco RAFI US 1000 ETF, ticker PRF, that's actually outperformed the Russell 1000 Value ETF, IWD, over the past 3 and 5 year periods.
And over the last
go back
years.
further. Exactly. Yeah, you can go back further. Same thing. We can look at the Invesco RAFI Emerging Markets ETF, ticker PXH. That's beaten the iShares MSCI Emerging Markets ETF, EEM. It's been meaningful outperformance. And so here's my question for you. Do you think investors have basically become hardwired to simply invest in these plain vanilla market cap weighted approaches? And if so, what are the implications of that? And there's some rationale here, right, to your point on growth outperforming, but it does seem like investors are just hardwired here.
Well, the short answer is yes. We tend to come to believe what we see and hear. And if all we see and hear is cap weighting is the obvious choice, well, it is the obvious choice. The market's cap weighted. You want to match the market, you might as well cap weight. And by the way, it beats everybody. So why bother? You get an extra 10 grand in your bank account. Don't leave it in the bank account. Pop it into VU, whatever. This narrative resonates because there's truth in it. Most narratives have an element of truth. Then academia comes along and says the markets are efficient. Any active decisions choosing this stock over that stock is a waste of time because the prices are correct. And so you're trained in business school to think markets are efficient. Any departure from cap weighting is inherently suboptimal, so why not index? Now, the theoretical perspective that any departure from cap weighting is suboptimal is theoretically impregnable. It's absolutely true if your index spans all investable assets. There's no index like that. If all investors have the same opinion as to the forward-looking return of all assets. What? If you can trade for free. If you can borrow and lend at the same risk-free rate. seems to me when you borrow, you're going to pay more than when you put your money in the bank. And if there's no taxes, and the list of ifs goes on. So basically, capital asset pricing model and efficient markets hypothesis are both the foundations of modern finance and are both beautiful approximations of the real world that are not the real world. And so finding gaps between theory and reality is a wonderful path to better performance. So, like I said, if value had merely kept pace with growth over the last 20 years, there's no question there'd be well over $1 trillion in fundamental index. If value had won by 3% a year and we were winning by 5% a year, there'd be 20 trillion in RAFI. That didn't happen. That's an alternative reality. And alternative realities are a fun game, but you better not take them seriously because they aren't reality.
Let's say we do get a prolonged period where value does outperform and maybe traditional market cap weighted approaches underperform. Do you think we could see a real shift in flows that investors, they will become not hardwired to just plunk money into VU?
It will create a shift in flows. It will do it gradually. I mean, think of it this way. The Dow Industrial Average was created in the 1890s. S&P was created in the 1950s. It took until about the 1980s before the return of the S&P was cited alongside the Dow, even though it was a much better index. And then Russell came along in 1978 and created the Russell indexes, Russell 1000, 2000, 3000, and shortly thereafter, Russell Growth and Value. Better indexes than the S&P 500 because it was deeper and it didn't rely on the subjective judgments of a committee to decide what to add or drop. Okay, that's an improvement. And yet roll the clock forward now, 45 years later, which is cited more often, S&P or Russell? Still the S&P. So there's enormous inertia in go-to standard investments. And so I think, roll the clock forward another 30 or 40 years, RAFI will be cited alongside Russell, S&P, and whoever are the other dominant providers at the time. I wish I could live long enough to see that. It's not very likely, but it's fun sowing seeds for a revolution. And apropos of that, we've created a new approach to cap-weighted indexing, RACWI. We've created a new approach to growth indexing, RAFI Growth. There's already an ETF tied to RACWI. There just might be an ETF in the not too distant future tied to RAFI Growth. I can't say anything about that, but it would seem perfectly reasonable. And do I expect these to take off and be embraced? In due course, over the course of long periods of time, yes. And so here I am, septuagenarian, feeling like I'm launching some new revolutions. Great fun.
You mentioned the RACWI ETF. Let's actually talk about that. As I noted at the top, this launched back in September. So RAFI Indices launched the RACWI US ETF, ticker symbol RAUS, RAUS. This was in partnership with ETF Architect. And I do think this really encapsulates some of the key points that you were just making. So do you want to explain this ETF?
All we've done is to borrow fundamental index uses fundamental selection and fundamental weighting. Choose companies based on how big they are, weight them on how big their business is, not on their market value. And that's the essence of RAFI. Well, it has a stark value tilt because it's not cap weighted. It underweights the growth stocks, overweights the value stocks. What if you don't want to do that? You want a market index. Well, you could borrow the fundamental selection. Instead of choosing stocks because their market cap has soared, choose stocks because their business has grown big enough to matter. And if you do that, you wind up changing what I call the active side of indexing. We have a monograph coming out, CFA Institute, which publishes the Financial Analyst Journal, also has a research foundation that publishes monographs. We have a monograph in the works that was invited by CFA Institute called the active side of indexing. People think of indexes as passive, and for the most part they are. Turnover tends to be 3 to 6% a year on average. So let's say it's 5% in a particular year. That means 95% of the portfolio is just sitting there blissfully indifferent to whether stocks are up, down, or sideways, whether businesses are flourishing or floundering. Doesn't care, doesn't matter. The 5% turnover is active. It's decisions what stocks to join the index, what stocks to take out. The stocks that join the index are almost always trading at a substantial premium to the market, and in almost all cases has soared in order to get onto the index. So imagine I came to you and said, I have this wonderful strategy. You're going to love it. I watch stocks, and after they've soared, I buy them. And I hold them because a lot of them are going on to great things. Now, some of them turn out not to deliver the goods. And so when they crater, I sell them. And it's all pretty mechanistic. I mean, if it soars above this threshold, I'm going to buy it. If it tumbles below this threshold, I'm going to sell it. What do you think? Most people would think that's stupid. But that's the essential element of cap-weighted indexing. Now, I'm not throwing stones at the big providers. This is how you would intuitively create a cap-weighted index. You'd add stocks after they get high enough in market value to justify being added. Those inherently will be stocks that have soared. They will almost always be trading at a premium. So you're buying stocks at twice the market multiple. You're selling stocks at half the market multiple. You're buying stocks that have outperformed on average by 7,000 basis points in the year before they're added. And on average, you're selling stocks that have underperformed by 7,000 basis points during the years that they were in the index. That's the average. Those flip-flops are really expensive. Can you mitigate the risk of flip-flops? Sure. Choose a different method for adding and dropping stocks. Wait until Palantir's business is big enough to say, yes, this is a solid, meaningful company. You will miss buying it after it soared. And if it goes on to wonderful things, you may pay a higher price. If it settles back down, you may pay a lower price by the time its business gets big enough to matter. And so all you're doing is changing the mechanism of adding and dropping stocks. Now, here's a remarkable thing. RAFI US has almost exactly 500 stocks. It's not by choice. It's not to match the S&P. We just choose 86% of the market, of the US market, based on the size of the business, and then we cap weight it. So Palantir won't make the cut. We're underweight that because we don't own it. Cheniere Energy, which has been in the news in the last few days, does make the cut. It's got a business about 5 times the size of Palantir's and a market cap about 5 times smaller than Palantir's. Okay, so you're adding big companies that are trading cheap. You're dropping little companies that are trading frothy. And you have 95% overlap. How do we weight those overlap stocks? We cap weight them. They have essentially the same weight as they have in the S&P. Small difference. The stocks that we add and that aren't in the cap weighted index, the big businesses that are trading cheap, because they're trading cheap, they're only 2% of our portfolio. Stocks we leave out are 5% of the S&P. So what do we do with that difference? We take that 95% overlap and we upweight it by about 3. So if NVIDIA is 7% of the S&P, it'll be 7.2% of our index. We're going to lightly overweight the Magnificent Seven in order to kick out the frothy companies at the bottom of the list. So that's RAFI. It's incredibly simple. It has a 99.9% correlation with the S&P 500. 99.9% correlation, and since the ETF was launched by ETF Architect last September, it's outperformed the S&P by 80 basis points, 0.8%. Doesn't sound like much, but in a business where people squabble over a basis point of fees, cap-weighted indexing is obsessed with fees and obsessed with tracking error. If you can beat the index in 6 months by 80 basis points with 99.9% correlation, that's pretty astonishing. And let me tell you, we've seen massive inflows. We had $10 million on day one. I was 8 million of it. And we have 40 million today. But it's off to a good start. And so do I expect to see it cross the 100 million mark in its first year? Yeah. Do I expect it to cross the billion mark in its first 3 years? Yeah. Do I expect to make a lot of money from this? No. For its first year, we said we're going to waive the fee. And so charging zero on zero assets is not very costly. And after the first year, we'll ratchet it up a bit. Its official fee is 15 basis points, which matches the Russell 1000 ETF. That's the most we can ever charge, because you can't raise the fee of an ETF. You can waive the fee downward. But whether we wind up at a price point higher than VU, of course we will. Higher than Spider, don't know. Higher than Russell 1000 IWB, can't go higher. So this is going to be a cheap ETF, not a super, super, super cheap ETF. And if it adds value, nobody's going to care.
With our remaining time, let me ask you this, and I probably ask you this every time that you're on here, but you mentioned this 80 basis points of outperformance, and you're right. You have a lot of investors are so focused on fees that maybe they miss something like that. But I would extend it to active ETFs as well, in the sense of there's a lot of managers out there. If they could generate 80 basis points net of fees outperformance, that'd be a home run. And as you know, a big story in the ETF world over the past several years has been this rise of actively managed ETFs. And from my perspective, I feel like the quote unquote smart beta ETFs, or these alternative approaches that we're talking about that RAFI offers, they have been put on the back burner a little bit. And so I thought, given that you are the godfather of smart beta, I'd love to close our conversation by having you compare and contrast here a little bit, just in terms of what words of wisdom might you offer to investors and advisors who are trying to make a decision between, say, a smart beta ETF, a RAFI strategy, and then traditional actively managed ETFs, because everybody wants to pick up that 80 basis points in alpha. So how do you think about this?
The most expensive mistakes in our business center on performance chasing. Other mistakes are an obsession with things that don't matter. A little bit of tracking error relative to, who cares if it's got a 1% tracking error relative to the S&P, for instance. Russell 1000 has a 1% tracking error relative to the S&P. And does anyone think Russell 1000 isn't a perfectly legitimate index? No. Do people care that IWB is more expensive than Spider by 5.5 basis points? Yeah, people care about that. 5.5 basis points is small enough not to be a central focus. It shouldn't be your decision basis. 50 basis points, sure. That's hard to make up with skill. But a handful of basis points, look at the quality of the product. Then ask, what's the active side of this strategy? If it's a strategy like fundamental index, the active side is selling stocks that have soared where the fundamentals haven't ratified that, and buying stocks that have tanked where the fundamentals haven't validated that price drop. So you ask the question, is the active decision in this strategy sound Is it something that I believe should work in the long run? And who's on the other side of the trade? If the other side of the trade is a performance chaser, performance chasing active managers, buying momentum, buying frothy multiples, that's the other side of the trade for RAFI. If the other side of the trade for cap weight is people who take some gains off the table by selling froth and redeploy that money in things that are newly cheap, that other side of the trade is a little worrisome. And in fact, cap weighted indexes empirically lose about a 50 to 100 basis points per year relative to their opportunity set with that trading, but nobody notices. And the reason nobody notices is that the index is its own benchmark. It can't underperform itself. So think about that. It applies in all sorts of things. The new RAFI growth strategy doesn't buy stocks because they're frothy and expensive, the way conventional cap-weighted growth strategies do. It buys stocks because their growth is fast. Their fundamentals are growing fast. It weights them on the dollar magnitude of that fundamental growth. And there's lots of cheap growth stocks. And the result is an index. We launched the index last March. So it's approaching its first anniversary. The last I checked, a couple, 3 weeks ago, it had already beat Russell growth by 1,300 basis points in a single year, because we're emphasizing companies that are fundamentally growing, and we're weighting them on their fundamental growth, not on their frothy valuations. So there's a lot of good ways to do things. Smart beta is a term that's been way overused. I was thrilled when Wall Street Journal called me the godfather of smart beta. The term smart beta was coined by a consulting firm, Towers Watson, in 2007, based on RAFI. And they said if it's an index that doesn't choose and weight stocks by market cap, it's going to have a rebalancing alpha. That's smart. We'll call it smart beta. The term has been expropriated by the industry and attached to everything under the sun. And the result is there's a lot of stupid beta strategies under the label smart beta. Look at the strategies and ask, does the trading in this strategy make sense? Or am I simply chasing past performance? If I'm chasing past performance, take a deep breath and ask, do I really want to do this? And is the person on the other side of my trade smarter than me? Sometimes you'd look at it and say, yeah, they might be.
Well, Rob, I think that is the perfect spot to end our conversation. It's always such great fun visiting with you. I really appreciate you taking the time here. Just a fantastic conversation. Thank you for joining me. And I look forward to seeing you at Exchange in Vegas next week.
See you then. Looking forward to it. All the best.
That was Rob Arnott, founder and chairman of the board of Research Affiliates. That'll do it for this week's ETF Prime. Next week, I will be in Las Vegas at Exchange 2026, where I will be taking the stage for several sessions, including one on ETF due diligence. I'll also be moderating another one on crypto. And then I will be recording a live version of this podcast with guests including Dimensional's Wes Krill, Bloomberg's Eric Balchunas, Morningstar's Ben Johnson, and VettaFi's Cynthia Murphy. So this is your last chance to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled networking. You can secure your very last-minute spot today by visiting exchangeetf.com. Hope to see you there. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.